So we know that US citizens have worldwide taxation to manage, of course, but how does that impact a US entrepreneur who's based here in the UK?
Well, entrepreneurs have to think about many different things, but particularly if you're an American entrepreneur and you've got a UK company, even though your business is here in the UK and has nothing to do with the United States, the owner still needs to report that company to the IRS annually, as well as make sure they're abiding by the US rules and regulations with respect to that company.
So CFCs, controlled foreign corporations, how are they defined and why are they a problem?
So a controlled foreign corporation is where a US shareholder owns greater than 50% of the shares of the foreign company. However, they take into account all US shareholders. So if any US shareholder with an ownership of greater 10%, if together they control over 50%, then that is considered a controlled foreign corporation.
And if that entity is a controlled foreign corporation, if it has subsidiaries, if there's a group, how does that work into the analysis?
Well, you need to consider the direct and indirect ownership of the Americans of the foreign companies. So where you've got a CFC and it's got subsidiary, 100% owned subsidiaries, it's very likely that all entities are CFCs, and that can create a reporting burden as you have to consider each entity individually, both for tax reporting and the application of the US tax rules.
So if you're an American, you've established you do have a CFC, a controlled foreign corporation. Aside from the compliance burden, what else can that mean?
So historically, there has been a regime in the US where if you're an American and you establish a foreign company, they ask, are you generating Subpart F income? And what Subpart F income is are you using your foreign company to basically create passive income? And what we mean by that is, are you using it for hold investment property? So you can't just take your investment portfolio and decide, if I put that into a UK corporation, well then it's hidden from the United States. You know, the US are wise to that, so as part of your annual reporting, you need to assess whether any of the earnings of that company are passive income. If they are, what the US says is, okay, you've got a foreign company. It's created some passive income, whether it be interest, dividends, gains, rental property, etc. Well, if you've made money in that foreign company, we're going to treat you as having earned that money personally because we think you're using that foreign company to shield that investment income from tax. Historically, if you were using your company for active income, so i.e. if it was a real trade, these rules didn't apply to you. They only looked at passive income.
So if you are a US owner of a CFC and you don't meet the Subpart F criteria, principally looking at passive income, that used to be the end of the analysis, but now non-passive businesses can also be caught by some anti-avoidance rules.
Yes, exactly. There is this wonderfully named global intangible low taxed income, referred to as GILTI, which basically looks to set a minimum tax on overseas corporate profits, which relates to income due from intangibles.
And what is an intangible for these purposes, and what kind of businesses get caught by these rules?
So this was initially brought in, particularly for large tech firms, where they were able to generate profits in countries where they didn't necessarily have a large amount of fixed assets. And by fixed assets, what we mean is kind of in a traditional sense of bricks and mortar, plant and machinery, and buildings, etc.
So in theory, a business that, an accounting firm, for example, that rents premises, has some computers and some furniture, but actually survives on its intellectual property, its goodwill, in terms of the value of its unpublished balance sheet, they can be caught by these rules.
Unfortunately, so. It covers anything that isn't tangible. So where you rent your property, or you might rent, your computers even. They are not fixed assets of the business, and therefore the profits that your accountancy firm makes can be caught as GILTI income for the US.
So it sounds like if you are an American that has a CFC and you're not running a manufacturing company or some other business with a lot of plant and machinery on the books, it's quite easy to be caught by these rules. If you are, how's it taxed?
It's similar to Subpart F income, i.e. the US owner actually has to pick up GILTI on their tax return and pay ordinary tax rates on that income. However, there are various elections as well as exceptions to that rule, because obviously this rule is there to attack income that is not subject to a high rate of tax. Although obviously with these new rules in place, you will have to think about whether actually using a foreign company is even the right structure for your business if you are an American entrepreneur.
Where a US person has an interest in a UK company or any non-US company, and that company isn't a CFC, a controlled foreign corporation, are there still rules that they may have to consider?
Well, the good news is if it's not a CFC, then we don't need to necessarily worry about the Subpart F or the GILTI rules. However, we do need to think about whether that foreign company is considered a PFIC, a passive foreign investment company. And a PFIC is generally a foreign company where the majority of its assets or the majority of its income are derived from passive sources such as interest, dividends or gains.
Okay, so passive income, really important to the analysis here. An American with an entrepreneurial business, a trading business, how likely are they to be caught by this?
Well, hopefully not, because particularly most active businesses will have trade and therefore not fall foul of the PFIC test. However, care does need to be taken because over the life cycle of the business, it's not inconceivable that the balance sheet or the income statement of that company could have passive income on it, which could flip it into becoming a PFIC. And once it becomes a PFIC, it's always considered a PFIC.
So something to watch, absolutely something to continue to manage. If a business is a PFIC, what is the impact on the owner?
Well, for the owner, when there is a dividend or more likely a sale of that business, that the income derived from it can be taxed at ordinary tax rates, plus an interest charge over the considered over the life of the holding of that PFIC. So it can get pretty penal, and the tax rates can go far in excess of 50% in cases.